Chapter 17, Auditors' Reports. Expressing an independent and expert opinion on the fairness of financial statements is the most frequently performed attestation service rendered by the public accounting profession. This opinion, which is expressed in the auditor's report, provides users of financial statements with an opinion on whether the statements are in conformity with the appropriate financial reporting framework, most frequently generally accepted accounting principles. The auditors cannot issue the standard audit report if there are conditions, although not departures from GAAP, about which the readers of the financial statements should be informed, such as lack of consistent application of GAAP, or there are material departures from GAAP in the client's financial statements, or the auditors are unable to obtain sufficient appropriate audit evidence, such as due to the client not retaining certain important records. Instead, they must alter their report to communicate such matters. Auditors most frequently report upon a complete set of financial statements, that is, the balance sheet, the income statement, the statement of retained earnings, and the statement of cash flows and related notes. The purpose of the notes to financial statements is to properly disclose information required by generally accepted accounting principles that cannot be adequately conveyed on the face of the financial statements. Adequate disclosure in the notes to the financial statements is necessary for the auditors to issue an unmodified opinion on the financial statements. The non-public company report begins with a title that includes the word independent and is addressed to those for whom the report is prepared. In the case of a corporation, the report is often addressed to the corporation, the audit committee, or its shareholders. The sections of the report include the opinion, basis for opinion, key audit matters when included in the terms of the engagement, management's responsibilities, and auditor responsibilities. It should be signed in the name of the firm, including its city and state. The report should be dated no earlier than the date that the auditors obtained sufficient appropriate audit evidence to support their opinion. This slide shows the information that is contained in the standard audit opinion for non-public companies. The report begins with the opinion of the auditors. The opinion shown is an unmodified or unqualified opinion. It includes the financial statements that were included in the audit, as well as the years, and states that they present fairly in all material respects the financial position, results of operations, and cash flows. The opinion paragraph would differ if the auditor reached another conclusion about the financial statements, as we will see later in the chapter. The basis for opinion paragraph includes the auditing standards that were used to conduct the audit, as well as a reference to the responsibilities of the auditor discussed later in the auditor's responsibilities section of the report. The paragraph states that the auditors are required to be independent and to meet other ethical responsibilities in accordance with the relevant ethical standards. It ends by stating that the auditors believe that the audit evidence obtained was sufficient and appropriate to provide a basis for the audit opinion rendered. This slide shows the wording for the key audit matters section if included in the audit report. Reporting of key audit matters is not required by non-public company auditing standards. They are included in the auditor's report based on the client's desire for their disclosure or when inclusion is required by law or regulation. When included, the report ordinarily only presents current period CAMs and not those of any other years of financial statements being presented. In identifying CAMs, the auditors select from the matters communicated to those charged with governance the matters that required significant audit attention. In making the determination, the auditors will consider areas of higher assessed risk of material misstatement or significant risk identified, significant auditor judgment relating to areas in the financial statements that involved significant management judgment, including accounting estimates that have high estimation uncertainty, and the effect on the audit of significant events or transactions that occurred during the period. For matters that are determined by the auditor to be key audit matters, the auditor should describe the matters, including why it was considered a key audit matter and how the matter was addressed in the audit. The management responsibility paragraph contains the information that management has taken the responsibility for preparing and presenting the financial statements in conformity with GAAP, and that this includes the design, implementation, and maintenance of the internal controls relevant to preparing and fairly presenting financial statements that are free of material misstatements, whether from fraud or error. The second paragraph states that it is management's responsibility to evaluate whether events and conditions indicate that there is substantial doubt about whether the company will continue as a going concern for 1 year subsequent to the issuance of the financial statements. The auditor's responsibility is contained in the next 3 paragraphs and includes the responsibility of the auditor to obtain reasonable assurance that the financial statements are on a whole free from material misstatements, whether due to error or fraud, and to issue an audit report that contains their opinion on the financial statements. The first paragraph also emphasizes that audits provide reasonable and not absolute assurance, and that even audits conducted in accordance with GAAP do not always detect material misstatements. Material misstatements associated with fraud often carry a higher risk of not being detected due to intentional acts such as collusion, forgery, misrepresentation, and override of internal controls. It then explains what constitutes a material misstatement. The next paragraph lists procedures involved in an audit that follow GAAP, and the last paragraph explains the auditor's responsibilities for communicating with those in governance the scope and timing of the audit, significance of audit findings, and certain internal control related matters identified during the audit. This slide shows the information that is contained in the standard audit opinion for public clients. The title of the report must include the words "Report of Independent Registered Public Accounting Firm." It must be addressed to the shareholders and the board of directors, or equivalent for companies not organized as corporations, although additional addresses may be added. The sections of the report include the opinion, basis for opinion, and critical audit matters, and these will be discussed in greater detail in the next slides. After the final paragraph, in addition to the CPA firm's signature, its city and state, and the audit report date, the report indicates when the firm began serving as its auditor. The first section of the report is the opinion. The first opinion paragraph will contain a description of the financial statements audited and a statement that the financial statements present fairly in all material respects the financial position, results of operations, and cash flows for the period in conformity with principles generally accepted in the United States of America. The second paragraph will state the opinion of the auditors for the company's internal controls over financial reporting and the framework used. When management has issued a report on internal control, but the auditors have only audited the financial statements, which generally occurs for companies with a market capitalization of less than $75 million, the second paragraph is deleted, and additional wording is added to indicate that the auditors obtained an understanding of material controls over financial reporting, but are not expressing an opinion on internal controls. The second section is the basis for opinion and states that the financial statements are the responsibility of management and that the auditor's responsibility is to issue an opinion in accordance with the U.S. federal securities laws and the applicable rules and regulations of the SEC and the PCAOB. The second paragraph explains that only reasonable assurance is provided and states the audit procedures that were followed. It ends with a statement that the auditors believe that the audit provides a reasonable basis for opinion. The third section, called Critical Audit Matters, is new and became effective for years ending on or after June 30th, 2019 for large companies and December 15, 2020 for the remainder. It states that the auditors communicated to the audit committee certain matters listed below that relate to accounts or disclosures that are material to the financial statements and also involved especially challenging, subjective, or complex judgments. However, these critical matters do not alter the opinion of the auditors. The critical audit matters would then be listed. The information for each CAM should include an identification of the matter, description of the principal considerations that led the auditor to determine that the matter is a CAM, and how the CAM was addressed in the audit. The standards require the auditors to include CAMs only for the current audit period, not all periods for which financial statements are presented, but the auditors may choose to communicate those of prior periods. This diagram represents a summary of the decision-making process for determining if an item is a key or critical audit matter. While the concepts of key and critical audit matters are similar, they are not identical. The definitions for the two are very similar, but there are differences in wording between the AICPA Auditing Standards Board and PCAOB standard that may create situations where the matters communicated are not identical. The primary focus of key audit matters is on matters of most significance during the audit, whereas the definition of critical audit matters focuses on matters involving especially challenging, subjective, or complex auditor judgment related to material financial statement accounts and disclosures. As an example of the difference, the implementation of a new information system might in and of itself qualify as a key audit matter. However, it would qualify only as a critical audit matter if it is considered to be related to material accounts or disclosures. However, the interpretational guidance in the AICPA auditing standards does emphasize the effect on accounts and disclosures. This slide summarizes the major concepts and requirements related to key and critical audit matters. This slide shows the definitions, the requirements for communication to those charged with governance, key requirements in addition to communication, and the requirement for inclusion in the audit report. Note that the key audit matters are not in general required, but the auditor may be required to communicate by the terms of the engagement letter. However, critical audit matters are required for most public companies, although there are some exceptions such as broker-dealers, investment funds, and benefit plans. This slide continues the summary and includes the years that are required to be reported. In both cases, only the current year key and critical audit matters are required. The detail of the disclosures are identified. Note that both key and critical audit matters must be included in qualified, emphasis of matter, and other matter audit opinions, but neither are required in adverse or disclaimers of opinion. The implementation dates for key audit matters and for other public companies were both December 15, 2020, but for large companies, critical audit matters were required in opinions issued on or after June 30, 2019, as previously stated. The four types of unmodified audit opinions include the standard report. This report may be issued only when the auditors have obtained sufficient appropriate audit evidence to conclude that the financial statements taken as a whole are not materially misstated and there is no need to add an emphasis of matter paragraph, an other matter paragraph, or to indicate a group audit situation. An emphasis of matter paragraph in an audit report is included to refer to a matter that is appropriately presented or disclosed in the financial statements, but is being emphasized through the audit report. An other matter paragraph in an audit report refers to a matter other than those presented or disclosed in the audited financial statements. The matter is, in the auditor's judgment, relevant to users' understanding of the audit, the auditor's responsibilities, or the auditor's report. An unmodified opinion on group financial statements includes a situation in which two or more CPA firms are involved in the audit of components of group financial statements, such as a subsidiary of a parent with 5 subsidiaries. When the audit firm that does the remainder of the audit does not wish to take responsibility for the work of the component auditors, the audit report is modified to divide responsibility between the CPA firms. There is no inclusion of an emphasis of matter or other matter paragraph in this situation. Modified opinions include a qualified opinion, which states that the financial statements are presented fairly in conformity with generally accepted accounting principles, except for the effects of some matter. Qualified opinions are issued when the financial statements are materially misstated or when the auditors are unable to obtain sufficient appropriate evidence on which to base the opinion. The likely effects, while material, are not considered to be pervasive. An adverse opinion states that the financial statements are not presented fairly in conformity with generally accepted accounting principles. Auditors issue an adverse opinion when the deficiencies in the financial statements are both material and pervasive. A disclaimer of opinion most frequently is the result of a scope limitation that creates a situation in which the auditors are unable to obtain sufficient appropriate audit evidence on which to base the opinion. All significant reasons for the issuance of a qualified or adverse opinion or a disclaimer of opinion should be set forth in a basis for modification paragraph. Primary circumstances that result in an audit report with an unmodified opinion but with additional financial statement related information include substantial doubt about the company's going concern status. Generally accepted accounting principles not consistently applied, reissued financial statements, and other circumstances that the auditors believe should be emphasized, such as uncertainties, unusually important subsequent events, a major catastrophe, or division of responsibility for the total audit. The professional standards require the auditors to evaluate whether there is substantial doubt about the client's ability to continue as a going concern for a reasonable period of time, which is defined as not to exceed 1 year beyond the date of the financial statements being audited. Conditions that may cause the auditors to question the going concern assumption include negative cash flows from operations, defaults on loan agreements, adverse financial ratios, work stoppages, and legal proceedings. When such conditions exist, the auditor should gather additional information and consider whether management's plans for dealing with the conditions are likely to mitigate the problem. If, after evaluating management's plans, the auditors conclude that the substantial doubt is resolved, they may issue a standard report and, at their discretion, an emphasis of matter paragraph relating to management's disclosure in the notes. If, on the other hand, substantial doubts still exist about the company's ability to continue as a going concern for a period of 1 year from the balance sheet date, the auditor will add a paragraph to their unmodified opinion or issue a disclaimer of opinion. Including an emphasis of matter paragraph with an unmodified opinion is the most frequent resolution. This slide illustrates an emphasis of matter paragraph relating to substantial doubt about a company's ability to continue as a going concern. The placement of a going concern section will differ based on whether the report is a non-public or public company report. For a non-public company, the paragraph will follow the basis of opinion section, but for a public company, it will come before the basis of opinion section. United States auditing standards for both public and non-public companies require that the auditors evaluate the client's current period financial statements for consistency of application of accounting principles in relation to prior periods. The consistency is required for all periods reported on and the prior period thereto if presented. If only reporting on one period, then consistency with the prior period, whether presented or not. A lack of consistent application of accounting principles results in an emphasis of matter paragraph. This slide illustrates an emphasis of matter paragraph for a lack of consistency in the application of accounting principles and states that the opinion has not been modified in respect to this matter. Again, the placement of this section will be different for the non-public and public company audit report. It will follow the basis of opinion section for non-public companies, but will be before the basis of opinion section for public companies. A client's correction of a material misstatement in previously issued financial statements also results in addition of an additional section to the audit report. This section is only included in the year it occurs and includes a statement that the previously issued financial statements have been restated for correction of a material misstatement and a reference to the entity's disclosure of the correction in the notes to the financial statements. The placement is the same as the going concern and consistency statements after the basis of opinion for non-public companies and after the opinion section, but before the basis of opinion for public companies. When the professional standards require auditors to include an emphasis of matter paragraph in the circumstances presented previously, the auditor may elect to include an emphasis of matter paragraph in other circumstances. While all financial statements are affected to some extent by uncertainties, it is only to those whose outcome is unusually important that auditors consider adding an emphasis of matter paragraph. Other situations would include significant related party transactions described in a note to the financial statements, that the company is a component of a larger business enterprise, or unusually important significant events, including a major catastrophe that has had or continues to have a significant effect on the organization. Also, if there are accounting matters affecting comparability, other than changes in accounting principles, of financial statements with those of the preceding year, the auditor may wish to add an emphasis of matter paragraph. In both the non-public and public company reports, the auditor discretionary matter paragraphs are placed after the basis of opinion section. This slide illustrates the relationship of component and group auditors. Group financial statements are those of a company that is composed of more than one component or subsidiary. When one CPA firm audits the entire group, no particular auditing reporting complications arise. It is when one or more components are audited by component auditors other than the group auditors that issues arise about the relative responsibilities of the various auditors. In this illustration, except for subsidiary C, the entire audit is performed by the group auditors. In this discussion, we assume that the audit report is required upon the overall consolidated parent company financial statements. When component auditors are involved, the group auditor should determine whether sufficient, appropriate audit evidence can reasonably be expected to be obtained regarding the overall group controls, the consolidation process, and the financial information of the components. In addition, the group engagement team should obtain an understanding of whether the component auditors are competent, operate in a regulatory environment with proper oversight, and will comply with all ethical requirements, and the extent to which the group engagement team will be involved with the component auditors, and will be able to obtain the necessary information on the consolidation process from the component auditors. As part of the process, the group auditor should communicate to the component auditors audit-related matters of which they should be aware. Some of the items included: informing component auditors how their work will be used, ethical requirements, a list of related parties, and significant risk of misstatements. The group auditors have two basic reporting alternatives under both GAS and PCAOB standards: to make no reference to the component auditors and as such assume responsibility for the entire audit, or to make reference to the component auditors and in essence divide responsibility for the engagement among the group and component auditors. This slide illustrates additional procedures that the group auditors would perform based on the nature of the component if the auditors make no reference to the component auditors. If the component is not significant to the group, then the group engagement team should perform analytical procedures at the group level and audit additional components if sufficient appropriate audit evidence has not been obtained. If the component is significant due to its individual significance to the group auditors or component auditors should perform an audit of the component. The group engagement team should be involved in the risk assessment and should discuss with component auditors or component management the business activities of significance to the group and susceptibility of the component to material misstatement. If the component is significant because it is likely to include significant risk of material misstatement to the group financial statements, then the group auditors or the component auditors should perform an audit of the component adapted as necessary to the needs of the group engagement team using materiality of the component, and should audit one or more component account balances, classes of transactions or disclosures, and perform specified audit procedures relating to the likely significant risk of material misstatement of the group financial statements. This slide provides a summary of the effects of certain matters giving rise to additional paragraphs and components of a group audit on an otherwise unmodified audit report. If additional sections for going concern consistency and reissued statements, then an unmodified opinion with an additional section will be added either after the basis of opinion for a non-public report or before the basis of opinion for a public report. If a group audit is handled either by reference to the component auditor or not, but is properly presented, then the report is unmodified, but the component auditors may be referred to if the group auditors do not take responsibility for the component auditor's work. This slide illustrates the auditor's judgment about the pervasiveness of the effects or possible effects on the financial statements of misstatements in determining the type of opinion that is issued. Misstated financial statements containing a departure from GAAP can result in an unmodified opinion only if the amount is not material, a qualified opinion if material but not pervasive, or an adverse opinion if material and pervasive. The inability to obtain sufficient, appropriate audit evidence, which is a scope limitation, can result in an unmodified opinion if the amount is not material, qualified opinion if material and not pervasive, or a disclaimer of opinion if the matter is material and pervasive. In determining the proper opinion the auditor will issue when there is a departure from GAAP, the auditor will base the opinion on the materiality of the departure and whether it is pervasive. As stated in the previous slide, an immaterial amount can result in an unmodified opinion. A material amount that is not pervasive in a qualified opinion, but a material and pervasive misstatement results in an adverse opinion. Effects of misstatements become pervasive when, in the auditor's judgment, they meet one or more of the following three criteria. They are not confined to specific elements, accounts, or items of the financial statements. If confined, they represent or could represent a substantial proportion of the financial statements. In relation to disclosures, they are fundamental to users' understanding of the financial statements. This slide illustrates the difference in reporting format for a modified or qualified audit report for non-public and public companies. When the audit report for a non-public company is qualified for a departure from GAAP, the modification involves qualifying the opinion, including the section title, and describing the reason for the qualification in a first paragraph added to what becomes titled the basis for qualified opinion section. The report's other paragraphs would contain standard wording. The audit report for a public company that is qualified for a departure from GAAP includes an additional paragraph that follows the opinion paragraph in the opinion section and does not include a title. All modifications for the public company audit report are in the opinion section. If a material misstatement is considered pervasive, an adverse opinion is appropriate. An adverse opinion is the opposite of an unmodified opinion. It states that the financial statements do not present fairly the financial position, results of operations, and cash flows. These opinions are issued when the auditors believe that the departures from GAAP are such that the financial statements taken as a whole are misleading. This is an example of the opinion paragraph when an adverse opinion is issued to a non-public company. When the auditors express an adverse opinion, they should include a paragraph in the basis for adverse opinion section, similar to that of a report with a qualified opinion, although the paragraph may be longer for a pervasive misstatement. When the auditors express an adverse opinion for a non-public company, the basis for adverse opinion section is similar to that of a report with a qualified opinion. The adverse opinion for a public company also has changes similar to a qualified opinion, with all changes in the opinion section, including the additional paragraph explaining the reasons for the adverse opinion. However, the PCAOB requirements to disclose critical audit matters do not apply when an adverse opinion is issued. Limitations on the scope of an audit may create a situation in which the auditors are unable to obtain sufficient, appropriate audit evidence. Such limitations may occur due to circumstances that were beyond the control of the client, such as important accounting records being destroyed or circumstances relating to the nature and timing of the auditor's work, such as the auditors were hired too late to observe the client's beginning inventory. The client can also impose scope limitations by not allowing the auditors to send confirmations to customers. Client-imposed limitations are very significant since they may have other implications for the audit, such as the auditor's assessment of fraud risk and consideration of whether to continue the engagement or to withdraw. This slide shows an audit report that has been qualified due to a scope limitation. The opinion paragraph includes the language except for the possible effects of the matters described in the basis for qualified opinion paragraph to direct the reader to the basis for qualified opinion paragraph, where an additional paragraph explains the scope limitation. The public company audit report with a qualified opinion due to a scope limitation includes the following modifications to the standard unqualified report. The information in the non-public company basis for modification paragraph is added as a second untitled paragraph in the opinion section. The public company's second paragraph in the basis for opinion section begins with, except as discussed above, we conducted our audit in accordance with the standards of the PCAOB. When the auditors conclude that the possible effects on the financial statements could be both material and pervasive, a disclaimer of opinion is appropriate. A disclaimer of opinion is no opinion. Auditors issue a disclaimer whenever they are unable to form an opinion or have not formed an opinion as to the fairness of presentation of the financial statements. Disclaimers cannot be issued when the auditors have formed an opinion on the financial statements. In particular, a disclaimer of opinion cannot be used as a way to avoid expressing an adverse opinion because auditors cannot ever avoid warning financial statement users about problems that the auditors know to exist in the financial statements. This slide illustrates the modifications to the audit report for a disclaimer of opinion for a non-public company. The opinion paragraph states that because of the inability to obtain sufficient appropriate audit evidence, no opinion is expressed on the financial statements. Then a basis for disclaimer of opinion paragraph is included to explain the nature of the scope limitation. The disclaimer for a public company includes the following changes from the standard audit opinion. The title of the opinion section is changed to Disclaimer of Opinion. The opinion is disclaimed as shown in this example, except the paragraph describing the reason for the disclaimer follows the opinion paragraph without a title. The title of the basis for opinion section is changed to Basis for Disclaimer of Opinion, and the second sentence of the first paragraph on auditor's responsibility and the entire second paragraph are omitted, as well as the critical audit matters section. An audit report may be qualified for two or more matters. For example, an audit report may include a modification for a scope limitation and a departure from generally accepted accounting principles. The wording of the report should include appropriate qualifying language and explanatory paragraphs for both types of qualifications. When there are several matters requiring the qualification of an opinion, the auditor should consider the cumulative effects of those matters. If the effect involves material and pervasive known misstatements, an adverse opinion would be appropriate, not a qualified opinion. The auditors may express different opinions on the different financial statements in the audit. For example, if the auditors were retained after the client has taken its beginning inventory count and the auditors were unable to obtain sufficient appropriate audit evidence relating to that beginning inventory, the auditors may issue an unmodified opinion on the balance sheet and a disclaimer of opinion on the other financial statements affected by beginning inventory. The auditor's report should cover the current year's financial statements as well as those for prior periods that were audited by the firm. The auditors may express different opinions on the financial statements of different years. In addition, auditors should update their reports for all prior periods presented for comparative purposes. Updating the report means either re-expressing the opinion originally issued or, depending upon the circumstances, revising the opinion from that originally issued. In some situations, the current auditors have not audited the prior period financial statements because those financial statements are either unaudited or audited by predecessor auditors. If prior periods were unaudited, then the auditors should issue a disclaimer on those. If the prior financial statements were audited by a predecessor auditor, the report of the predecessor auditors may be reissued by them, bearing the original date, or the current auditors may refer to the report of the predecessor auditors in an other matter paragraph. The other matter paragraph should include the prior period financial statements were audited by predecessor auditors, give the type of opinion expressed, and if the opinion was modified, the reasons therefor, the nature of any emphasis or other matter paragraph included in the predecessor's auditor's report, and the date of the predecessor auditor's report. Most publicly owned corporations are subject to the financial reporting requirements of the federal securities laws administered by the Securities and Exchange Commission. Many of the reports or forms filed with the SEC include audited financial statements for 1 or more years. Among the most important of these forms are the following. Forms S1 through S11 are the registration statements for companies planning to issue securities to the public. Forms SB1 and SB2 are the more simplified registration forms for small businesses. Form 8K is the current report filed for any time a significant event occurs for a company subject to the Securities Exchange Act of 1934. If the significant event is a business combination, then audited financial statements of the acquired company are often required. Form 8K is also used to report a change in auditors. Form 10Q is filed quarterly with the SEC by publicly owned companies and contains unaudited financial information, but the company's auditors perform reviews of this information. Form 10K is filed annually with the SEC and contains audited financial statements and other detailed financial information. And this is the end of the presentation for Chapter 17.